The year is 2024, Wall Street is buzzing, the American economy is roaring back to life, deal-making is rampant, and the scent of profit hangs heavy in the air. This is a full-blown revival. The ghosts of the 2008 financial crisis have been laid to rest. This is a new era of unbridled optimism and boundless opportunity. Amidst the euphoria of Wall Street's resurgence, a compelling narrative unfolds in the East. Public sector undertaking banks in India, often perceived as lumbering giants, are experiencing a remarkable turnaround. Their stocks, once considered laggards, are now the darlings of the market, registering impressive gains that have caught the attention of investors worldwide. The nifty PSU Bank Index, a key barometer of the sector's performance, surged by an astounding 24.08% in 2024, outpacing the benchmark Nifty 50 Index and the Nifty Bank Index. This surge is a testament to the Indian government's unwavering commitment to economic reforms and the bank's proactive measures to clean up their balance sheets and improve operational efficiency. Several factors have contributed to this remarkable turnaround. Political stability, a cornerstone of economic growth, has fostered investor confidence. The government's relentless push for digitization and financial inclusion has unlocked vast untapped markets, particularly in rural areas. Furthermore, PSU banks, once burdened by non-performing assets, have made significant strides in addressing this issue. This, coupled with improved credit disbursement practices and reduced union interference, has bolstered their financial health and made them attractive investment propositions. Morgan Stanley, a stalwart of Wall Street, is emblematic of the financial sector's resurgence. The investment banking giant reported stellar third-quarter earnings for 2024, with net revenues soaring 16% to reach a staggering $15.4 billion. Net income witnessed an even more impressive surge, jumping from $2.4 billion in the same period last year to $3.2 billion. This robust performance is a testament to Morgan Stanley's diversified business model and its ability to capitalize on the prevailing market trends. The bank's institutional securities division, its traditional stronghold, roared back to life, driven by a surge in mergers and acquisitions activity and a buoyant equity market. Wealth management, another key revenue driver, also witnessed significant growth as clients, buoyed by the economic recovery, entrusted Morgan Stanley with their growing fortunes. Investment banking revenues, a key indicator of deal-making activity, witnessed a remarkable 56% year-on-year surge. This surge was particularly pronounced in the EMEA region, where Morgan Stanley played a pivotal role in several high-profile M&A transactions. Equity revenues also painted a rosy picture, rising 21% year-on-year in the United States and Asia. The financial bonanza on Wall Street isn't limited to corporate coffers. Bankers and traders, the foot soldiers of this financial revolution, are also reaping the rewards of their labor. Wall Street bonuses, a closely watched barometer of the industry's health, are poised to surge by an average of 35% in 2024, marking their first significant increase since 2021. This surge in bonuses is a natural consequence of the industry's stellar performance. With banks raking in record profits, they are more than willing to share the spoils with their employees, especially those in high revenue-generating roles. The Federal Reserve's decision to lower interest rates, coupled with the surge in M&A activity, has created a perfect storm for Wall Street bonuses. Debt underwriting specialists, instrumental in facilitating the surge in bond issuances, are expected to see their bonuses jump by a staggering 25 to 35%. Equity capital markets professionals, who advise companies on raising capital through share sales, are also in for a windfall, with bonuses projected to rise by 15 to 25%. This bonus season is a stark reminder of the lucrative nature of the financial industry and its ability to generate immense wealth, both for institutions and individuals. Goldman Sachs, another titan of Wall Street, is also basking in the glow of the financial resurgence. The investment banking behemoth reported a jaw-dropping 45% increase in profit for the third quarter of 2024, with total revenue surging 7% to reach an impressive $12.7 billion. This stellar performance underscores Goldman Sachs's dominance in the investment banking arena. The bank's investment banking revenue, a key driver of its overall profitability, soared by 20%, fueled by insatiable demand for acquisition financing. Companies, flush with cash and emboldened by the favorable economic climate, are on a buying spree, and Goldman Sachs is perfectly positioned to capitalize on this trend. The bank's asset and wealth management division also turned in a stellar performance, with revenue surging 16% to reach $3.75 billion. This growth is a testament to the bank's ability to attract and retain high-net-worth individuals and institutions seeking to grow and preserve their wealth. Goldman Sachs's impressive performance is a microcosm of the broader trend sweeping Wall Street. The financial sector, once on the brink of collapse, is back with a vengeance, and Goldman Sachs is leading the charge. The wave of optimism sweeping the financial sector isn't confined to America. European bank stocks have climbed over 25% in the past year. This surge shows the interconnected nature of the global financial system. European banks are benefiting from favorable factors. Rising interest rates have boosted their profits. Stock buybacks and dividends have enhanced shareholder returns. U.S. banks' median total return in November 2024 was 13.4%. This pushed the median price to adjusted tangible book value to 155.1%. European bank stocks remain relatively inexpensive. With a price-to-earnings multiple of 6.5 times, they offer a compelling value proposition. The current resurgence in the financial sector, while impressive in its own right, is not without historical precedent. In many ways, it mirrors the boom witnessed in the mid-1990s, a period of unprecedented economic prosperity and financial innovation. Just like in 1995, when the Federal Reserve's decision to cut interest rates paved the way for a surge in bank stocks, the current boom is also fueled by loose monetary policy. The soft economic landing engineered by central banks, coupled with deregulation under the new political landscape, has created a fertile ground for financial institutions to thrive. However, the current boom also bears some resemblance to the post-2008 financial crisis recovery. Back then, the financial sector, after teetering on the brink of collapse, staged a remarkable comeback, fueled by government bailouts and a surge in risk appetite. This recovery, however, was accompanied by a significant shift in sentiment, with increased scrutiny of Wall Street's excesses and a greater focus on regulation. The current resurgence, while exhilarating, should also serve as a reminder of the cyclical nature of financial markets. Booms are often followed by busts, and it is crucial for investors and policymakers alike to learn from past mistakes and strive for sustainable growth. The financial sector, despite its remarkable resurgence, is not without its challenges. The global economy, while on a growth trajectory, is still grappling with inflationary pressures and geopolitical uncertainties. The ongoing war in Ukraine, supply chain disruptions, and the looming threat of climate change cast a shadow of uncertainty over the future. The Federal Reserve's decision to raise interest rates, while necessary to tame inflation, could potentially stifle economic growth and impact the financial sector's profitability. Moreover, the regulatory landscape, though currently favorable, could change rapidly, especially in the wake of any future financial crises. Despite these challenges, the financial sector is well positioned to navigate the uncertain terrain ahead. Technological innovation, particularly in the fields of fintech and digital currencies, presents immense opportunities for growth. The rise of sustainable finance and impact investing also aligns with the growing demand for socially responsible investments. The key to sustained success lies in embracing innovation, managing risk prudently, and adhering to the highest ethical standards. As the financial sector embarks on this new chapter of growth and prosperity, it must do so with a keen eye on the future, ensuring that the lessons learned from past mistakes are not forgotten.